Where do we go from here? What are we looking at? So we've had the quickest or deepest correction to the stock market since the Great Depression, and the biggest move in the market since 2009. So what does that mean? Is it over? Is it just getting started? How do we get here? So let's kind of dig in a little bit and try to talk about that. Now, I was preparing a presentation for clients to get out at the beginning of March. And I was putting some slides together. And if you listen to my last podcast, you'll see I talk about how richly valued, in fact, extremely richly valued, the stock market was. And in fact, I think it was just getting to be kind of ridiculous. You saw companies like Tesla get a market cap, meaning the value of the company was worth more than Volkswagen. To put that in perspective, Tesla made just under 400,000 automobiles last year, while Volkswagen made 10 million. You can hand me all the jazz you want about Tesla being an advanced company or a great company or product loyalty, blah, blah, blah. But to say it's worth more than a company that makes 10 million cars, more than 20 times the number of cars, that's just ridiculousness. So I always start off, whenever I try to think about investing, there's a difference between investing and speculation. And Benjamin Graham, who was Warren Buffett's mentor, in his seminal work, Security Analysis, defined investing as an operation in which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. So I was going to start talking about just the valuations in the market. So before we even get into coronavirus and all that good stuff, I just want to give you a little bit of a backdrop to where the market was before all this started to happen. So the stock market, by many measures, is now more expensive than it's ever been, ever. Even the 2000 tech bubble, the 1929 pre-depression stock market, in many metrics, it's very, very expensive. This is just some of the slides. And it kind of shows you, the first one is price to sales. So the price of the stocks in the stock market relative to the sales is now at an all-time peak, last reached in 2000. Also, the same goes for enterprise value divided by EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Again, I don't expect this to mean a lot to everybody, but I'm just showing you that the market is really richly valued. Here's a couple more just showing you. The big one at the bottom, U.S. equity market cap divided by GDP. So the value of all the publicly traded stocks on the stock exchange is now worth substantially more than the size of the economy. And when you think about it, the publicly traded companies really aren't the biggest part of our economy. It's small business. So when you get a valuation like this, and this is Warren Buffett's favorite predictor of value, when you get a valuation like this, the market is grossly overvalued, and that is at an all-time high. Here's some other things just to show you that we are in the very top of the historical percentile as far as a lot of different figures. Again, market-adjusted price to earnings, enterprise value to sales, U.S. total market cap to GDP, all in the top 99 percentile historically. You can see some of the other ones. The one I've always liked is cyclically adjusted price to earnings ratio, also known as the CAPE. It's in the 96th percentile. And earnings aren't as bad as things like sales and enterprise value because companies have been buying back their own stocks. So that pulls the number of shares out, which then increases the earnings per share. So if you're still with the massive amount of shares that have been bought back over the past few years, and we're still in the 96th percentile for price to earnings, that kind of tells you the market's a little bit ridiculous as far as valuations. And again, I was putting this together before the big week with the coronavirus. Okay. So what does this all mean? What does valuations mean? Well, valuations don't give you any idea of what's going to happen in the short term, even though this week, probably looked like it was a telltale. But valuations give you an idea of what you could expect over the next few years. So this kind of gives you what we might be looking at with the S&P 500, or generally the benchmark for the U.S. stock market over the next 10 years, using different metrics. So the Shiller metric is the one I talked about just a little bit ago, the CAPE ratio, cyclically adjusted price to earnings. Shiller's projecting about 2.6% per year in the U.S. market over the next 10 years. Another famous one is Jeffrey Tobin's metric. He's calling for a slight negative over the next 10 years. Warren Buffett's metric, market cap to GDP, is calling for about a 2%. That's 2% annually for the next 10 years. And John Paul Tudor Jones, or hedge fund manager, is predicting a negative 4.1%. Another one that I use a lot is a company called GMO, Investment Management Company. So they have had a fantastic record of predicting the ensuing 7-year returns. They're looking at 7 years instead of 10, but they're looking at a negative 3.7% annualized for large company U.S. stocks, negative 1.5 for U.S. small company stocks. The only place they see really a good positive return are in emerging value stocks. You also notice in bonds, they're expecting negative returns in bonds for the next 7 years. Now, I'm not doing all this to bum you out. I'm just trying to give you an idea based on valuations, today's valuations. This is kind of what they're looking at for the next 10 or 7 years. So again, valuations give you a clue to future returns. This is a pretty convoluted chart, but the orange line is basically the price to earnings ratio at the start of a 10-year period. And then the blue or green lines give you the actual return over the ensuing next 10 years. So you can see basically when the orange line is up high, the blue are low, which means high P/E ratio, low returns, and vice versa. So we are, again, at very high levels of the P/E ratio. So that kind of portends that we should see much lower returns over the next 10 years. Again, I did this before this coronavirus market downturn. This is a variance between CEO and consumer confidence, and it's never, ever been wider. So the CEOs are pretty bearish, but consumers were very wildly optimistic. Now, after this week, I can assure you that this chart probably isn't going to be quite like it is now, but this was before the coronavirus downturn. Another thing to notice is, again, going back to Benjamin Graham, where you're looking for safety of principle and some value. Well, there's two kinds of stocks, a growth stock and then a value stock. So a growth stock is exactly what you would think. It's a fast-growing company. So you're talking your Teslas, your Netflix, Apple, Google, Facebook, all of those. Those are growth stocks. Value stocks are going to be things that have been beaten down or that are pretty boring. They're reliable, high dividends. So we're talking about consumer products, Kimberly-Clark, which makes toilet paper, Colgate makes toothpaste, a lot of these things. And sometimes value, just companies that got beaten up. Right now I'm going to talk about some of the energy sector. It's just been pummeled, but there could be value there. So traditionally, value has outperformed growth. But what we have been seeing really since the end of the 09 market downturn is growth has just pummeled value. It hasn't been a good time to be a value investor. And in fact, right now, we are seeing the distortion between growth to value at its all-time high. So that tells me that if you're an investor over the next few years, you're going to want to be allocated more to value companies than growth. I think growth has grown so far, as I mentioned in the beginning of this, like Tesla, it's just ridiculous. So I think at some point, money is going to go to more reliable earnings, higher dividends, less volatility, and that's going to be value stocks. And again, I'm just setting things up here, talking in general. We haven't even started talking about what we're looking at with the coronavirus. Again, this is just another chart kind of showing you the variation between growth and value. So value, the past few years, has been returning substantially well below growth. So, everything in life is cyclical, everything, and that includes the stock market. So this is just another reason to think value. Just to give you kind of an idea, looking at the tech bubble, the housing bubble, and then today, to show you another example of why things are so expensive. This is looking at different sectors. So everything from the consumer discretionary and staples to utilities to healthcare to energy materials, all the way down to real estate and financials. So you can see in the tech bubble and the housing bubble, there were sectors of the economy that were actually pretty well valued. They weren't overvalued. They provided value to investors. But today, there's some slim pickings. I mean, every sector is near the top of its all-time high valuations. The only ones that look compelling are energy, which again, I'm going to talk about in a little bit. Healthcare looks quite compelling. Financials, I wouldn't go anywhere near financials right now. I just don't trust them. But they also show some lower valuations. This is just another graph looking at valuation by sector. So here again, you can see healthcare probably in this chart is fairly valued, but it's not overvalued. But energy is severely undervalued. So there's some potential there. But the other sectors are seriously overvalued right now. Just another chart. Not going to spend too much time. If you want to dig deeper, you can pause this webinar and take a look. But again, just trying to make the case a little bit for energy. If you look over the past 12 months, it has not done very well at all. Everything hasn't done well this last week, but this was before the little coronavirus hiccup here. So you can kind of see that there's some value there with energy. Okay, so remember, when you buy a stock, what you are buying are earnings. You're buying the future earnings of a company. That's what you're getting. And what we see is the market up until this week has been going up, 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 but earnings are actually going down. That's not a good thing. That's telling you that the market is really getting too far ahead of itself, especially if earnings are dropping. And then we'll talk a bit here about what earnings might do due to the coronavirus. And if I haven't bummed you out enough, here's another thing that has me alarmed. Starting last year, well, really in 18, we started to see what they call the yield curve inversion. All that means is that long-term bond are actually starting to have a lower yield than short-term bonds. And what that tells you is that the bond market is pricing in very low growth. Because if you think about it, if you're going to loan me money, if you loan me $20 for a month, as opposed to loaning me that $20 for 10 years, you're going to want higher interest on that 20-year loan, right? Or a 10-year loan, because there's a lot more chance that I might default, or there's a lot more chance that inflation might eat away at your valuation. So typically you're going to see shorter term bond yields much lower than longer term. But when this inverts, when the longer term bond yields are less than short term, again, that's saying the market is saying we're expecting some tough times ahead, deflation. We're expecting low GDP growth. So we have seen that, and it has been exacerbated with this last week. Bond yields have dropped like a rock. So it is quite inverted at this point. Inversions have a pretty good record of predicting recessions. Now, the time after the inversion until the recession, it's not anything that's instantaneous. I think the shortest period ever for that was something, like 12 weeks. And as long out as 12 months. So it doesn't mean that it's happened now that we're going to see recession right away, but it does portend some bad times ahead. Okay. So now that I've already got you freaked out, now let's throw in the coronavirus, which has been fun for everybody. Again, the fastest drop in the market since 1929. Also, the biggest move, and I should say the fastest drop in the market since 1929 from a peak, from the top. So in 29, the market kind of hit its all-time high and then kind of dropped precipitously about 10%. It did recover from there, but then, of course, it dropped even more. So, but this is the biggest move we've had in this shorter period since 2009. And there's a kind of a side of me that's kind of happy to see it. 10% market corrections are not a bad thing. They happen usually at least once or twice a year. Now, this one was painful in that it happened within a week, but people were getting ridiculous. I mean, again, bidding up Tesla, it's just crazy. I keep going back to Tesla because it's nuts. But even companies like Apple, Apple went up 84% in 2019, but their earnings went up 2%. So there was some just ridiculous tactics, habits, processes, whatever you want to say, with investors. So this little market hiccup here is probably going to slap them back to sanity, which so that's not a bad thing, honestly. But the big question is, what is really going to happen with this coronavirus? How is it really going to play out? Is it what we call black swan? Now, black swan was a term used to basically say in olden times, they never thought it was possible to see a black swan. Everyone in Europe had only seen white swans. And then they went down to Australia, and what did they discover? A black swan. So what a black swan means is it's a completely unexpected event, something that people think cannot happen, and then it does happen. So it's not something you can factor in before. When I talked about the overvaluations and everything like that, that's pretty much known information. It's not a black swan. It's there. Even with the housing collapse, now everybody can see the reasons for it, but a lot of people didn't see it at the time, but it was there. It wasn't something that was hidden. It wasn't something that just emerged from nowhere. This coronavirus is a black swan. The question is, how bad is it going to be? Is it just a regular kind of flu 2.0? 99% of the people will get through it and just have a few bad days. Well, if that's the case, if they really find out, okay, hey, this is just a flu, then, we can kind of expect the market to shrug this thing off and start to rally. However, if fears continue, I wouldn't be surprised if this drives us to a full recession. And when you get to the point where you start to really see recession, along with record high valuations, that's a recipe for disaster, folks. It really is. I mean, I'm not going to sugarcoat it. It could be bad. Now, I don't know which it's going to be. I have no idea. I have no idea how this thing plays out. I mean, there's so much misinformation and just general theses flying around. Nobody really knows. But I can say with 100% certainty, it has impacted the economy already. The supply chains are already seeing some issues. So that means that a lot of companies are not going to be able to build their product just because they're not going to be able to get parts, mostly because a lot of these parts are coming from China. It's also already had a massive impact on travel, and travel is a very large part of the world's economy. Europeans coming here, we're going to Europe, cruises, flights on airplanes, all that kind of stuff. If the fear continues and people, whether it's right or wrong, but if people keep this up and they start to actually avoid public places, what if people stop going to the movie theaters or restaurants or traveling? What's going to happen to those industries? What's going to happen to those people that work in those industries? Well, more than likely, they're going to be laid off. So this does have the potential to be something bad, or it could just be something that's overblown. We've had pandemics before that were overblown. The Ebola incident and the SARS, a bad incident again, it got contained. It wasn't nearly what they had predicted. In both cases, the market dropped pretty steadily there for both of those events, but then they recovered very quickly and got past this. So, what does that mean? Well, the first thing I'm really watching is what's the Fed going to do? Okay, I don't think the Fed should do anything. I think the Fed has done too much already, and they've sort of distorted the market, which is why we're at record high valuations. They keep pumping in liquidity and money into the markets, and that has created a market that is manufactured, controlled. But the problem is when those get away from you, it's like a dog on a leash. You keep that dog on a leash forever, but if it gets off, man, it is gone. So anyway, but if the Fed comes out this weekend and starts to jawbone about providing more liquidity than they already have, well, I think that'll be some support for the stock market. And this chart kind of shows you right here that the stock market has always gone up when liquidity's been pumped in. Doesn't mean it, well, I shouldn't say always, but typically what you find is when they're pumping money in, the stock market tends to like it. But the problem here is we're already at extremely low interest rates. How much can the Fed really do? I know that they could just pump more in through quantitative easing, but is it going to work? If the economy really starts to stagnate and the Fed is doing quantitative easing or dropping rates and that doesn't do it, well, then we're in for some real hurt. But I am watching that. So if we see something pop up there, I would expect stocks to pop. Now I'm going to deviate a little bit here. This, again, jumping back to what I was doing even before the coronavirus. And I've already mentioned that energy is an area that I think there is some value, that it wasn't ridiculously overvalued. This is showing you XOP. That's the ticker symbol. But basically, these are the gas and oil exploration production companies. This goes all the way back to the 2008 debacle. So you can see, if you look at the far left, that's the 2008-2009 bottom. So the price of crude oil per barrel is $33. And the top 30 companies in XOP had earnings per share of $27.29. Okay, let's move it all the way down to 2016 when oil had another bear market and dropped to $26 per barrel. Again, the top 30 weights in XOP actually had negative earnings there, negative $63. So they really got hammered because the price of oil went down so far. Now you notice where the stock price was in both of those cases. Now let's move it to the far right to today. Okay, not today. I guess I should take that back. This was actually before the drop that we just had. Crude at 51 a barrel. So we're talking almost double what it was in 2016. And then, substantially higher than it was in 2009. So you have their basic product at $51 a barrel. Even today, after this past week, oil is still at $45 a barrel. And the earnings per share for the top 30 companies in the XOP is $68.49. So earnings way higher than they were at the two previous downturns. But yet, look at the price of it. It's below where it was in 2009 and in 16. Okay, and it's dropped even further with this recent coronavirus scare. So you've got the product input double what it was, and earnings substantially 300% bigger than they were, but yet it's trading that low. So I think there's some value in energy. I really do. And just to kind of give you another view of it, tech stocks divided by energy, we're almost to the point where we were in the top of the tech bubble in 2000. So, relative to technology, relative to the growth, energy is offering some compelling valuation. So when we start to get back into this market or add new sectors, expect me to be adding energy. Now, I know some people don't like to do energy because, they're green or whatever like that. But, my job is to try to make you some money. I'm not here to put values to it, quite honestly. I mean, it's publicly traded companies and we're trying to find valuation. If you have a problem, just let me know. We can talk about it. Anyway, so I've mentioned to all of you before that what I try to do to mitigate risk is I look at the 200-day moving average for equities. So what's a 200-day moving average? Well, you take the closing price of whatever equity holding you're looking at over the past 200 days, and it gives you an average. And that's about a year long when you factor in weekends, holidays, all that good stuff. So anytime the market is trading above the 200-day moving average, you want to be invested. That's a bullish signal. But when it breaks below a long-term trend, that's when you want to kind of take notice, maybe go to the sidelines, put it in cash or bonds. So I'm just kind of giving you an idea of how the 200-day moving average works, going back to the 2002 bear market. So here you can see this is VTI, which is the Vanguard Total Stock Market Index. The red line here is the 200-day moving average. So you can basically see in roughly September of 2000, the market moved below the 200-day moving average and stayed there until really April of 2002. It bounced up just for a little bit and then came back down below. So using the 200-day moving average in that case would have basically prevented a sizable downturn. That 2.5-year downturn would have really helped investors out to have sold at that position and just waited for the market to go back above it. How did it do in 08? Well, here again, you can kind of see a little bouncing around in 2007. Bounced below it, came back up, bounced below it, came back up. And typically, that's how bear markets start. Bear markets don't start the way they happened this week with a big precipitous drop. They usually don't happen that way. I always compare bear markets to when you get nauseous, right? When you're about to throw up, what happens? Okay, I'm nauseous. I feel bad. All right, we're getting below the 200-day moving average. Then what happens? Okay, it's passing. Okay, I feel better. I'm sweating a little bit, but I'm feeling okay. Okay, we're back above the 200-day moving average. Oh, wait a minute. Oh, God, it's back. Okay, I'm nauseous. Down below it. Back up again. Feel great. Okay. All right, we're sweating, but we're feeling good. Then eventually it just pukes it up. That's usually how bear markets work. So you can kind of see that's how it happened back in 07. You can see back and forth, but then essentially in July, in June, July of 08, it broke below the 200-day, and it just never came back up until I guess it was July of 2009. That's when it came back. So here again, using that 200-day, you might have had some zigzags in 2007 if you were following it just religiously. But it still would have helped you avoid the major downturn in 08. Now, much like back in 07, if you looked at it from like 2010 to 2012, we had several periods where it went below the 200-day and above, below and above. So it's not a perfect record by any means. It can zigzag you in and out a little bit. So it's not a perfect metric. Nothing is perfect, but it can help you from the big turn. So what does that mean? What am I talking about here? Well, so with this week, the market had been trading well above the 200-day moving average for a while now. This chart, if you look at the red line again, that's the 200-day moving average. So what that means is at the end of the day on Thursday, the market broke below the 200-day moving average, and it dropped you a little bit further today on Friday. So we're below the 200-day moving average. Okay, so should we sell? Well, possibly. Now I'm expecting probably some weekend jawboning to try to get the markets to go back up. But it's basically right at the 200-day moving average. This chart also shows a couple other uptrends, like longer-term uptrends. The blue line that's below the red line is kind of an intermediate-term uptrend, and then the gray line is the uptrend going all the way back to the bottom of the 2009 market bottom. So, we kind of have some support just below S&P at 3,000. And then probably the other support would be 2,800. So if things really still kind of panicked a little bit, I would expect we would test either that 2,950 range or the 2,800 range. And if they can hold that, then you might see a nice bounce up from there. If it violates both of those, then I think we're in for some trouble here. But for right now, we are a little bit below the 200-day moving average. So what am I going to do? Am I going to get out now? And I do want to preface, everybody probably notices I've got quite a bit of cash and bonds. We have been underweight equities for really since 2017. So that served us well in 2018, but it didn't in 2019. I know a lot of folks that talked to me, we didn't get probably the same upside in 2019, but I've been saying, hey, valuations. So we have been better positioned than probably a lot of people, and also better positioned than what we might typically be. But still, what do we do from here with the rest of the equities that we have? So again, my process, I don't do it the moment it breaks below the 200-day moving average, because within a day it could bounce back and forth up above the 200-day moving average. So what I try to do is the beginning of the month, which is coming up on Monday, and then mid-month, that's when I look to trade, big moves for the accounts overall. Obviously, if a client calls and needs money or something like that, I'll do trades in between there. But that's the big moves that I look at. That's kind of, I try to do it to get rid of some of the noise. So come Monday, if we're still below the 200-day moving average, if the weekend jawboning didn't work and the market's still kind of tanking or just sort of holding, I'm probably going to sell. I'm going to sell the equity positions, and we're going to go to bonds and cash and just kind of sit there. Now, the market might bounce right back up, so we could miss something, because I'm probably not going to look at it again. I'm going to stick with my system and wait till mid-month. And then we'll look in the mid-month. If it's back above the 200-day moving average, we'll know it's kind of safe to get back in the water, and we'll do it. So again, if this is a blip, at worst, we'd be back in mid-March. But if it's not, if it's really kind of a start of a bigger trend, then we're going to stop the roller coaster ride at this point. So we'll see what kind of happens, and I'm going to try to stick with the system. This is, you got to have a system. As soon as you start violating, every time I seem to violate from that, I end up making things worse. But some of the moves I am going to be making, I was going to do anyway. Utilities and consumer staples have really, they've served us well the past few years. We've done pretty well with them. I've been going into those really since 17 with an overweight, and they've done well, but I think it's time to get out. I'm also looking to do some more value, and one of the great value strategies that I've always liked is what they call the Foolish Four, or dogs of the Dow. So basically, you're taking the lowest price, highest dividend companies in the Dow. So what that usually means is those are the stocks that have been beaten down, so they're paying a higher dividend and have a lower price. And right now, those companies are Dow Chemical, Verizon, Pfizer, and Walgreens. So we'll probably add to those. And again, as I've mentioned here several times, I want to overweight the energy, and I'm going to do that through a couple of different ways. The gas and oil explorers, which are a little bit more volatile, but I think some very good value there. XLE is also an energy, but it's kind of hitting on some of the bigger companies. So you're going to have some of your Chevrons and Shell oils and Exxons and things like that in there. So a little bit more developed there, a little bit more diversified energy holdings there. And then the Alerian Master Limited Partnership, AMLP. These are energy infrastructure. So it is pipeline companies, shipping companies, things like that. And what I like about these, the Master Limited Partnership is structured to provide, they have to pay out 90% of their profits to company or to the shareholders to avoid corporation taxation. So to avoid taxes at the corporate level, they have to kick out 90% of their profits. So this thing is yielding over 9% right now. So even if it just sits where it's at, we just sit back and collect 9%. Not a bad deal. So those are kind of some of the moves I'm looking to make. The last three there, the sell utilities, consumer staples, the Foolish Four, and then overweight to energy. I was going to do those anyway. But so if we get back in, I'm definitely going to add that because, again, I'm trying to find some value in this overvalued market. So again, I don't know what's going to happen with this coronavirus, but kind of rest assured, I'm going to try to make sure that we use that 200-day moving average so that if this thing is really going to head south, that, again, we're not going to ride that Bronco all the way down. And worst case, if we sell and then things start to pop back up, we might miss a little bit, but that's kind of what what you have to do to mitigate some risk. So yeah, that's basically it. I've had quite a few inquiries from clients, not as many as I thought I'd get. So hopefully that's a good sign that you felt confident, or you knew to ride it out a little bit, or would take a long-term approach. That's great. But I wanted to get this out just so that everybody could kind of understand what I'm thinking. It might ease your mind a little bit. But anyway, if you have any questions, I do hope that you'll reach out, contact me, and we can obviously talk about that. So with that, I will wish you a good night.